Good afternoon and welcome to our weekly webinar. I'm Kathy Fettke, co-CEO of Real Wealth Network, and I'm so happy that you could join us on this holiday week. It was a little bit of a risk, shall we say, to bring on one of our favorite speakers during a holiday week, but then we thought, well, maybe that's exactly what everybody wants, is to talk about real estate right on the last day of 2020. Some positive things that have happened in our industry. So I'm super excited for this webinar. We had record signups and registrations. So I think I'm not the only one excited to hear about how 2021 is going to be the best year yet. Rick, right? That's what you're saying? I'm sure of it.
Don't want to
See.
spoil the surprise. Don't want to spoil the surprise for everybody, Kathy.
Yeah, not spoiling it. All right. But I hope you all had a really wonderful time last week with family and maybe getting the thing you always wanted underneath the Christmas tree. I know this has been hard times for a lot of people too. And I do want to say that the holidays aren't over for me. And if there is somebody in need that's had a tough time, please let us know. We have a program we'd like to help. So you can always reach out to Kathy@realwealth.com if you know someone who needs food for one thing. Of course, we want to be able to help with that. All right, so and we still have people coming on, but we'll get started. So today's webinar is on the 2021 outlook for real estate. There are a lot of questions out there. There's a lot of experts who have different opinions on the topic. At the end of the day, we really have no idea what the future holds, but based on data and graphs and charts, we can make educated guesses, right? And our guest today has lots of charts and data. So we're really excited, Rick Sharga, to have you here with us. You're now with RealtyTrac. And you're back with them, I should say. And so I'd just like to hand it over to you because I know you're the reason everybody's here today. Oh, but before we do that, we have upcoming webinars. Next week, I'm going to be giving my housing market predictions, which will be somewhat in line with what Rick is going to be talking about here, but I'll also bring in some other topics as well. So that's next Thursday, my 2021 housing market predictions. And then on the 14th, we'll be talking taxes again. We had one of the most attended webinars just last week on taxes, and there are changes. There will be more changes. So it's really important to stay on top of these things. I learn every time. I think just when I thought I knew everything, it turns out I find out I don't. And so we have to keep learning. It's an ongoing process. All right, so let's go to the next slide, and that's probably your intro page. There we go. So Rick Sharga is Executive VP of RealtyTrac, so he's a big deal, leading foreclosure. And RealtyTrac, if you don't know, is a leading foreclosure search and discovery website. So maybe hasn't been too active over the last few years, but might be again in the coming years. National authority on real estate, mortgage, and foreclosure trends. In fact, Rick and I have been on some of the same interviews at the same time when I was in New York City and I was on Bloomberg. I didn't know till I was on live that Rick was there with me, and we got to talk real estate, and it's always an honor. He's been featured on CNBC, CBS Evening News, NBC, CNN, ABC World News, and Fox, just to name a few. And of course, Real Wealth Network today. All right, so Rick, I'm just going to hand it over to you. I just cannot wait to hear what you have to say.
Well, thank you, Kathy, and thank you for having me. And I got to tell you that these conversations are always a lot more enjoyable than being on CNN, CNBC, and Fox News, because among other things, you're there, so it just makes it that much better.
Well, you
so
know,
we're
the
going to
thing
go through.
you get like 30 seconds to sum up everything that's going on. It's pretty tough. Yeah, so you get more than that today. We're going to give you lots of time.
You don't have to be a soundbite machine on the Real Wealth Network. That's a good
right.
thing. So that said, we're going to cover a lot of content in a fairly short period of time. I know you're going to be posting this video. If anybody's interested in the slides themselves, feel free to share them with anybody who's registered today. We're going to cover the U.S. economy briefly. We're going to talk about the housing market. We're going to talk about what's going on in forbearance and foreclosures. So, you know, a 3-hour seminar in the next 20 minutes is what we're going to be doing today. But it's important to take a look at.
I'm going to jump in really quick and just let people know that we are taking Q&A at the end. So you can add your questions into the little question box, and we'll get to it at the end. So don't think we're ignoring you. We're just going to get through the presentation first.
Yeah, and I'm hoping we get a lot of good Q&A, because that's candidly more interesting than hearing me talk for the next 20 minutes. So I do think it's important for us to have an idea what's going on economically, because that drives a lot of what happens in the housing market. And so, you know, not a big surprise to anybody who's been paying attention for the last 9 months, but the economy's gone through a real roller coaster ride. We had a record quarter-over-quarter drop back in the second quarter, 31% decline in the gross domestic product, which typically is how people measure the economy, and then a 33% swing up in the third quarter. And for those of you that failed basic math, that doesn't mean we're actually ahead of where we were. We're still a little bit behind. So if you take away 31%, yeah, and then build 30% on top of it, you're not quite where you were. The fourth quarter numbers, largely because we've seen such a huge spike in COVID cases, we've seen that growth rate slow down significantly. So odds are when the fourth quarter numbers come out, we'll still see positive numbers, we'll still see growth, but at a lot slower rate than we saw in the third quarter. And really, a lot of economists are hedging their bets on where they see 2021 going until we have some idea about how quickly, how widely these vaccines will be distributed, and how and their efficacy rate in terms of getting this pandemic under control. A lot of small businesses have suffered quite a bit, and because of that, we've seen unemployment rates do just ridiculous things. Looking at this chart, there's two things we're covering here. The big blue bars are the new unemployment claims. And we saw unemployment rates go from about 3.5%, which was the lowest they've been in 50 years, to almost 15% in literally 1 week. It was an unprecedented jump. We've seen the numbers come down pretty dramatically since then, and they're heading in the right direction, but we're still seeing an unusually large number of claims, somewhere in the neighborhood of 800,000 new claims every time they announce the numbers. So moving in the right direction, but you know, the improvement has slowed down quite a bit. The little dotted line you see running across there is a metric I didn't often cover, but I'm watching now. It's continuing claims. So we've seen the same sort of thing happen there. As the unemployment rate spiked, you saw people who were unemployed for longer periods of time. And that's probably a more important number to watch as we go forward, because the way we'll know we're getting out of the recession is how quickly the jobs recover. And this chart, which is probably a little hard to read, and I apologize for that, shows how quickly jobs came back during prior recessions compared to this recession. So if you look at that green line that goes all the way across the page, that's how long it took us to get back to normal levels of employment during the Great Recession. It was called in the media the longest sustained period of economic growth, but you can see how slow that growth was. It took us a decade to get those jobs back. If you look at what happened this time, and that's the dark colored line at the left-hand side of the chart, we had a V-shaped recovery in terms of jobs. We got about half of the jobs back in about a month and a half, which is just unprecedented. But you can see that growth rate in terms of the jobs returning has begun to slow. And what that suggests is that it might take us a couple of years to fully recover those jobs. And that's jobs both in terms of where we were, but also in terms of where we would have been if we hadn't had that interruption in the growth rate. A couple things to point out here that makes this different than prior recessions and have very specific implications for the housing market. One is that, again, typically when we have job losses in a recession, they're permanent job losses, and it's going to take a long time for them to come back. In this case, a lot of the job losses were temporary, and they were filed as temporary job losses when people filed for unemployment. And you see that, again, about half of them came back in a fairly short period of time. The other thing that's different is this recession was really focused on a handful of industry segments: retail, restaurants, travel, tourism, hospitality, entertainment. And those markets or those segments tend to be populated by employees who are hourly wage earners, who are fairly low paid in the overall scheme of things. They tend to be younger. They tend to be less formally educated. Because of that, because of all those factors, they tend to have very low home ownership rates. So this particular recession skewed much more heavily in terms of job losses toward renters than it did toward homeowners. And that's one of the reasons why the home ownership rates are actually at a 10-year high right now, is because we haven't seen the kind of fallout in the housing part of the market that we would typically see in a recession like this. Now, don't be completely fooled. One of the other reasons, because of the government programs that have protected homeowners. We'll talk about that in a little bit. But that rental market is something to keep your eye on. And I know a lot of Real Wealth Network members own rental properties. And there are pockets of the country where we see rental owners with high LTVs. They're highly leveraged, where we also see high rates of unemployment. And those could be potential trouble spots depending on how long it takes the economy to recover. There we go. While this is going on, it's been almost unfathomable how quickly the housing market has recovered. I was doing a webinar back in May with a well-known housing market industry analyst, who I won't name because it would be embarrassing right now, who confidently predicted that existing home sales would be down by 40 to 50% year over year compared to 2019 numbers. That was probably a miscalculation. As of the end of last month, we're actually about 6% above 2019 numbers on a year over year basis. And the pending home sales numbers that tend to show what's going to happen in January are up 16% year over year from last January. So there was a lot of pent up demand in the spring. So you can see the beginning of the year, if you look at the red bars, the beginning of the year started off very strongly. And even in March, we were on track for a really good month before the pandemic hit and everything shut down. April, May, and June are usually months where we see growth. We actually saw declines in April and May, and June numbers were still off year over year. But over the summer and throughout the fall, the numbers have come back with a vengeance. And the demand is being driven organically for the most part. There's really three things that are driving demand. One is simply demographics. The average age of a first-time home buyer is 35. The largest group of millennials is now between the ages of 31 and 34. The pandemic, and this is the second driver, the pandemic accelerated a trend we were already starting to see, which was urban renters becoming suburban homeowners. And when the shelter-in-place orders hit, a lot of those urban renters found out that it probably wasn't quite as much fun to be quarantined in a 700 square foot apartment with a toddler as they thought it might be, especially when they couldn't go to their favorite restaurant and get out of the apartment for a while. So we've seen a real acceleration in what people are calling urban flight. And I see it happening particularly in high cost markets. So New York, San Francisco, to a lesser extent, Seattle, where you have high cost markets that people typically didn't want to commute in and out of for jobs. We are seeing people move out of those markets. The vacancy rates on apartments in those cities are going up. The rental prices are going down. And then the other driving factor is we have historically low mortgage rates. So a lot of people that would have thought about buying, but maybe not done so in the past, are looking at a 30-year fixed rate loan at 2.5% and realizing quickly that in many markets, it's actually cheaper to buy than it is to rent. So that's another driver of what's going on. We're seeing this in spite of the fact that the inventory of existing homes for sale is the lowest it's ever been since the National Association of Realtors started tracking these numbers. And partly this is a combination of low inventory of homes for sale coupled with the high pace of sales activity. but partly it's just that existing homeowners in many cases are reluctant to list their properties because they don't want strangers in the house during a pandemic. They also don't want to be out looking at strangers' properties for their next house during a pandemic. And some people are candidly a little concerned about the stability of their jobs because of the recession. I don't want to take on a new financial commitment when they're in a kind of stable environment where they are. But we have this high demand, we have low inventory. The demand, just to give you another way of looking at the demand, this is the Mortgage Bankers Association weekly survey of purchase applications for loans. So these are the people that are applying for a mortgage. Normally we're in a down cycle this time of year, but for I believe 27 consecutive weeks now, the applications have been higher than they were a year ago, and year to date, 26% higher than they were in 2019. So people are applying for loans in large numbers. So high demand, low inventory, that drives prices higher. And you can see on the chart on the top here that prices adjusted a little bit for inflation, aren't quite back to the last bubble, but are approaching it. What's been interesting though, is you really have a hard time overstating the impact on affordability of those low mortgage rates. So at the same time, we're having the Realtors Associations talk about record high prices for median priced homes. We're also seeing that the average mortgage payment on a year-over-year basis for those properties is lower than it was a year ago. So big difference. Now, the most recent numbers showed that prices were up nationally over 10%. In fact, I saw something this morning that suggested it could have been as high as 14% year over year. And so you can't have that go on for any appreciable period of time, or you do hit an affordability wall. But we're not there yet, and it'll be interesting to see how the market sort of settles itself. Again, I believe once we get to where people believe the pandemic is more or less under control, you'll see a lot of existing homeowners bring their properties to market, which will present more buying opportunities and should help to tame home price appreciation before it gets completely out of control. New sales, sales of new homes, easy for me to say, have been even stronger than existing homes. And part of this is that urban flight we talked about a little while ago. The National Association of Home Builders is talking about an unprecedented percentage of these new home sales being for properties where the builder hasn't even broken ground yet. So you have people buying homes on spec. The last housing boom we had, builders were building on spec, and they were putting up a lot of properties, not knowing if anybody was going to buy them, but assuming they would, and they wound up overbuilding. And this time it's just the opposite. We have people going out to developments and paying full price for homes that the builders haven't even started construction on. But most people were predicting that we'd wind up with somewhere between 600 and 650,000 new homes sold this year. We'll definitely wind up exceeding that in spite of the pandemic, which is just, it shows that Kevin Costner was right in Field of Dreams when he said, if you build it, they will come. And these numbers continue to improve. The builders would be selling more, except they have nothing left to sell. The inventory of existing new homes that have been built that are available for sale is also at an historic low. And this is a chart I always find interesting. It's from a website called Calculated Risk, which is one of my favorite websites. And what it shows is new homes that have been built that are available, new homes that are under construction, and basically new homes that haven't been started. So building permits, housing starts, but not the ground hasn't been broken and construction hasn't started. And if you look at the red, those are the ones that are completed, and those numbers remain way below historic averages. The fact that the blue area, the under construction area, is moving up is a very good sign. We need that, and that's really going to help balance the supply-demand imbalance we're dealing with right now. But that's really kind of a graphical representation of how out of control the builders got during the last boom, how they basically stopped building after the bust, And depending on whose numbers you follow, they've been underbuilding compared to demand by about 300 to 400,000 units a year since the Great Recession. The good news on this front also is that it looks like the housing starts numbers are trending in the right direction. Still not exactly where we need them to be, but you can see that they're moving up. And this chart shows both the housing starts and the new home construction completion, usually about a 6-month lag time between those two. But again, you can see compared to historic averages, we're still below where we need to be. We probably need to be above that million unit a year number, and we're getting there, but we're not there yet. None of these, by the way, virtually none of these are entry-level homes. So the lack of inventory is most dramatic at the entry level, but builders simply can't afford to make a profit on entry-level homes right now. Cost a builder on average about $80,000 before they break ground across the country, according to Fannie Mae. Lumber prices are going up, labor prices are going up. So if your table stakes are $80,000 and you haven't started hammering a board, it's really tough to make money on the lower priced homes. So the builders are focusing on higher priced homes. There's now a demand for bigger homes, so you can have a home office because you're working from home. Maybe a place for your kid in case you're going to be homeschooling. So the good news is any inventory the builders bring, it helps because it gives people at the lower price points an opportunity to trade up, which opens up their property for that next generation of homeowners.